Welcome to the Dough Roller Money Podcast. I'm your host, Rob Berger. Today, in episode 330, I'm going to respond to a question that was left in the Facebook group by Joshua, a follower of the podcast and obviously a member of the Dough Roller Facebook group, which, by the way, would love to have you join doughroller.net / Facebook group. And I think we're up to I don't know, 8 or 9,000. Whatever. It's a big group, and they by and large behave themselves, so that's good. But seriously, they're very helpful. I think helping one another with questions and answers and resources. So would love to have you join. But in any event, that's where this question comes from, and he asked an important one. I'm actually going to break it up into two episodes. This is a twofer. So in this episode, we're going to cover. Well, I'll tell you what. Let me read you the question. And then I'll tell you how I'm going to break it up into two shows. And both of these are probably shows where it would be helpful for you to actually watch the video because you're going to be looking at my computer screen much of the time. But not to worry if you don't have that available to you. I'll be walking through it as well in the podcast. So here we go from Joshua. He says, "Hi, Robert Berger. Big fan of the show and appreciate the insight that you share. I had the joy of listening to episode 197 titled 5 Costly Myths About Dividend Investing. Enjoyed listening and would agree with everything you shared. My question is, before COVID-19, great minds like Jack Bogle, and by the way, he's passed away, but he was the founder of Vanguard. Great minds like Jack Bogle did estimate that over the next 10 years, market appreciation was not likely to be as high as it customarily is. With COVID-19 now having ravaged markets, I can't help but think this bolsters Jack's argument. The 4% rule is highly contingent on capital appreciation of stocks/indexes being near the 7 to 9% historical averages, I believe. With all of that being said, if capital appreciation is potentially stagnant and markets go horizontal for 10 plus years, would it not make sense to then invest for income versus appreciation in the form of dividends? Case in point, VYM, Vanguard High Dividend Yield, is comprised primarily of long-term companies, and the index fund yields 3.7%. Well, it's a great question. It's actually many questions in one, really. I mean, there's a lot of topics, which is why I'm going to break this in two. And what I want to do today is talk about this VYM that he mentions, Vanguard High Dividend Yield, and what it is, and also the idea that the 4% rule, and if that's new to you, well, we're going to talk about it in this episode, but it was, the idea came from an advisor by the name of William Bengen. He wrote an article way back in 1994, and what he said was, based on his analysis, you could take out in year one of retirement 4% of whatever you've got saved up. So we'll just use $1 million. If you have $1 million saved up, year one of retirement, you can take out 40 grand. And this is what trips some people up. In year two, you can adjust the amount you take out by the rate of inflation. So year two has nothing to do with the balance, right? You could take out 40 grand in year one, and maybe the market was on a tear, and at the end of year one, you had more than you started with. Maybe you had $1,050,000. Doesn't matter. In year two, you take out whatever you took out the previous year, plus an amount that equals inflation. That's going to end up being a really important point, as you'll see. So that's what we're going to cover in this episode. And then in the second episode that follows this, I guess that would be 331, we're going to look at the issue of dividends, why I both love dividends, but don't love them in the way I think a lot of people do. Because the reality is dividends do not make you richer. Is that how to say it? Wealthier? They don't make you richer. I like richer better. Anyway, in fact, I think you can think of dividends a lot like required minimum distributions. They have a lot in common. Anyway, that's what we're going to cover in the next episode. So I'm breaking Joshua's question up into two episodes. And so that's the plan. So I want to begin, let's just first get VYM out of the way. Let's make sure we understand what, it's an ETF, but you can find similar investments in mutual funds. But what's that all about? So I'm going to pull up Morningstar, So I'm in Morningstar. I'll go back to the quote. This is the Vanguard High Dividend Yield ETF. Again, ticker is VYM. Boy, look at that. It's got 5-star Morningstar rating. I don't, by the way, put any weight at all into the Morningstar ratings at all. They have no bearing on my investment decisions. And by the way, that's not because I'm critical of their star rating. It's just not really relevant if you're a buy and hold index fund investor. You just get a good asset allocation with low cost index funds, and that's pretty much all you need. But here's what I want to show you on this fund. If we come down here, we can see that the yield, they actually have two different numbers. They have what's called the SEC yield and the 12-month yield. And they both hover, we'll call it around 4%. The SEC yield is 4.15. The 12-month yield is 3.88. These are just different ways of calculating the yield on this fund. And by yield, you can think of it primarily as dividends. There may be some interest in there. I'm not sure if this has any bonds in it. We can actually take a look, but primarily dividends. And the SEC yield is actually a formula I'll show you here on the screen that, as the name suggests, the SEC lays out. It's basically looking at the yield over a 30-day period. The 12-month yield is something that Morningstar calculates, and again, as the name would suggest, what they do is look at the last 12 months of interest and dividend payments and calculate a yield based on the current price of the investment. So that's why they're a little different, and they'll almost always be a little different. But we can, for our purposes, we'll just say 4%. Now, the first question to ask is, well, is that like higher than normal? Like, is there a normal? What should a mutual fund pay in dividends? What should its yield be? Well, there really is no one answer to that, but we can look at, say, an S&P 500 index fund and say, okay, what does it pay? So let's jump over to the Vanguard 500 Index Admirals Fund, VFIAX. Now, this is a mutual fund. For our purposes, that doesn't really matter. And I'm going to jump over to the quote section. And we can see the SEC yield is 2.26. So, yeah, big difference, about 1.75% roughly. 175 basis points different in the yield. And the Vanguard High Dividend Yield Fund, and I'm actually going to split these out on two different screens if you'll bear with me. Here we go. So if you're watching the video, you can see them both now on the screen. And big difference in the yield. And that gets to the question of, well, does that make is a higher yield investment better than a lower paying investment? Well, the answer is yes and no. It's not either. I always look at total return. Now, let's talk about what that means. When you think about returns, you can think about the value of the underlying investments going up, right? That's one component of our return. So you buy a stock at $100 and whatever, a year later, it's worth 105. It's gone up in value. And that's true whether it's a stock, an ETF, a mutual fund. And then there's the income that the investment can produce, right? The yield, the dividend, if it's a stock, the interest, if it's a bond. And both of those are important, right? You add those together to get the total return. And when you look at returns, say on Morningstar, and let's do that now. Let's look at these two funds and see how they've performed over time. And we'll start with the Vanguard High Dividend Yield, and we'll look at the averages. So if we come down here, we can see total return over the last 10 years has been 10.24%. That's pretty strong. That's everything. That's a total return. That's not just dividends or just capital appreciation. It's both. If we come over to the Vanguard S&P 500 Index Fund, though, let's see what it's done over the last 10 years. Well, it's actually done better, 11.56%. It's done better by about 125 basis points, and that's after fees, although the fees on both of these investments are quite low. Now, again, we should say that we don't know that these funds, how they'll do over the next 10 years. We don't know, obviously, in absolute terms, and we also don't know relative to each other. I mean, the S&P 500 Index Fund won out over the past 10 years, but over the next 10 years, for all we know, the Vanguard High Dividend Yield ETF will do better. There's no way to know, but we shouldn't underestimate the significance of the difference that we're looking at now. A difference of 125 basis points in return over 10 years, as I think longtime listeners should know, is huge. And that raises the question, though, well, Yeah, the high dividend paying investment, maybe total return uh, wasn't as good, but it pays a much greater yield. And goodness, at 4%, if we were invested in this and we're in retirement, we might not have to sell anything. We could just live off, it's 4%. It's kind of what we've all been conditioned to believe we're entitled to in retirement, right? We could just live off the yield. We don't have to sell anything. If we have this S&P 500 index fund, sure, we get some income to what, 2.25%. Let me just make sure I've got the number right. Yeah, roughly 2.25%. But we would have to sell shares to make up the other 175 basis points. And so, it might have done better in a total return environment, but in retirement, we'll end up with a lot fewer shares. Now, we're going to cover that issue in more detail in the second podcast, the next podcast. But I will say this. I think a lot of folks view dividends as sort of like having your cake and eating it too. You get the benefit of all these checks coming in every quarter, but you don't have to sell shares. And we kind of, I think emotionally, and by the way, I'm guilty of this, we take comfort in this idea that we can extract money out of an investment without selling any of the shares. It turns out that you're in no better or worse position. This idea that selling shares puts you in a worse position is just not mathematically true. And in fact, there's an argument that you're much better off selling shares to generate the money you need rather than relying on dividends. And in fact, dividends, as much as I love aspects of them, have a lot of downsides. And but we'll get to all of that in the next show. What I want to focus on now is, having looked at these two funds, to think about them in terms of the 4% rule. And how did William Bingen look at this? Was he thinking about total return? Was he thinking about the dividend yield of an investment? And maybe more importantly, to going back to Joshua's question, and I pull it up on the screen now, what do we do about this idea that the market could go sideways for a long time? Shouldn't that scare us? Is it particularly someone that's in or near retirement? If you're 20 or 30, goodness, you'd love a bear market. You want a bear market to last for decades. Well, unless you had to take care of your parents, but whatever. In terms of an investor, when you're accumulating, man, a bear market is like the absolute best thing that can happen to you. You want it to be awful. Not that you want other people to suffer, but you know what I mean. But once you're in retirement, a bear market's kind of scary. And so should we maybe even be willing to give up some total return in exchange for a higher yield? That's a trickier question. So let's turn to Mr. Bingen's article, which I've got up on my screen. And in fact, there he is. In case you were ever wondering what the actual title of his article was, it was not the 4% rule. That didn't exist when he wrote this article. It came up after his article. His article is called Determining Withdrawal Rates Using Historical Data. And that historical data is important for our purposes. So what I want to show you to begin with is, we're going to come back to some other pieces of this article. If you're a money nerd, it's a phenomenal article. I highly recommend that you read it. We're going to look at a chart. And for those listening to this, it's a pretty simple chart. What he did was he started in 1926 and he said, okay, let's assume someone retires with whatever, we'll just say $1 million. And he first assumed they would take out 3% from the portfolio in year one. And then again, thereafter, adjust that amount, in this case, in our hypothetical $30,000, adjust it each year for inflation, all right? And then he said, okay, if they do that and they invest their money in 50% stocks and 50% intermediate term treasuries, so a 50-50 portfolio, how long would their money last? And what he decided to do was to see if it would last at least up to 50 years. That was the number he picked. Obviously, if you retire at a traditional age, more than enough time, right? And so what you see on the screen, if you're watching the video, is sort of bar charts. And each bar represents how long the portfolio would have lasted. He stopped at 50 years. That was the most. Assuming you retired in 1926. Assuming you retired in 1927. Assuming you retired in 1928. And what he did for each year was he just mapped it out, 50 years. And he used actual market returns. This was not, let's just assume 10% for this and 5% for that. He used actual market returns, and this is important, actual inflation numbers. That's going to come back in a big way in just a minute. Now, he did have to make, some assumptions because he was writing this in 1994. And so eventually he got to a point where he had to make some assumptions for 95, 96, 97, and he assumed 10.2% on stocks, and I think roughly, I may have that off, but it's 10 point something. And I think 5.2, maybe it was 10.3 for stocks and 5.2 for bonds. But like beginning in 26, you go out 50 years, you're at 76. I mean, for up to like the early 40s, he was using actual data, right? And even after that, most of it was actual data. He only used the assumptions once he got past 1990, I guess 4, when he wrote this article. Now, at a 3% withdrawal rate, regardless of when you retired, any time between 1926 and 1976, your money lasted 50 years. Now let's think about that for a minute. You survived the Great Depression, the market crash of 29, the following Great Depression. You survived World War II. You survived the Korean War. You survived, I guess, all of Vietnam. Intact as a retiree, 3% withdrawal rate. Now, you stuck to a 50-50 portfolio, you rebalanced every year, and you never deviated from that. That's critical. You never deviated from 50-50. So when you had scary times, and there were plenty of them, we're going to get to them in a minute. They were real scary. You just said, yeah, I listened to the Dough Roller Money podcast, and I'm not changing my investment strategy. Okay, maybe you didn't say that in 1927, but you get the idea. Now, where does the 4% rule come from if all of this is about a 3% withdrawal rate? Well, he decided to look at different withdrawal rates, and so he bumped it up to 4%, and there's another chart just like the first one, but it's got a 4% withdrawal rate in year one and then adjusted each year for inflation, and the chart doesn't look quite so smooth. There are some years where if you retired in a certain year, your money did not last 50 years. Now, that's the bad news. The good news is, the worst scenario, it lasted about 35-ish years, which I think for most of us retiring at, say, 65 will be more than enough. The majority of the years lasted all 50 years, but again, there were, let's see here, 3, 6, 9 years that didn't quite make it. And what's interesting about all of this are the years that didn't make it. And that's what I want to talk about today in response to Joshua's question, because right now, we're concerned about our markets, obviously. COVID-19, never lived through anything like this before. I'm guessing you haven't either. And yeah, frankly, I'm surprised the market is doing as well as it is. I'm surprised it's not down more. I keep thinking, what's everyone thinking here? But we could be in for a long, ugly, not just stock market, but time, economically, and of course, health and other things as well. So shouldn't we learn from the history and maybe do some adjustments? Well, let's dig into those years where your money didn't last. Again, remember, the worst year, it still lasted about 35 years. That's not so bad. That should cover, I think, just about all of us in retirement. But let's still nevertheless dig in and figure out what happened. Now, what's interesting to me when I look at this chart is you can see some things that are surprising. For example, wouldn't you think that someone retiring in 28 or 29 or 1930, wouldn't they be the worst? I mean, I may not be the most knowledgeable historian, but I'm pretty sure there was like a market disruption sometime around, October 1929. They all lasted 50 years. You retired in 1929, you were great at a 4% withdrawal rate. It wasn't until someone retired in 1937 that they ran into trouble. And they ran into trouble, again, by the way, their portfolio, and if you retired in 1937, lasted almost 40 years. So I guess saying they're in trouble is a bit of an exaggeration. But 37, it didn't quite last 50 years. And let's see here, if I got the numbers right, I'm looking at the chart. I guess if you retired in 39 or 40, it still lasted over 40 years, but not quite 50. And that's a head scratcher. Now, for you stock market historians, you might say, oh, Rob, that's not a head scratcher at all. We know that the late 30s were ugly economically. They were really bad. And it's true. I just finished a book, a biography of William Randolph Hearst, the big publisher, and the grandfather to Patty Hearst, which I guess maybe some of you remember. Anyway, yeah, he almost lost his entire empire in the late 30s. It was as much because he spent every dime he made and 5 more he didn't, but that's a whole other topic. But still, why are they so bad in that year? And 28, 29, 30, not a problem at all. What's up with that? That's the first question. And the second question is, if we fast forward on this chart, we can see that things really start to get ugly in the 60s and 70s. There's 1, 2, 3, 4, 5, 3, 6, 7 years. 7 years where, again, 35 years or more, but still 7 years that don't make it to 50 years. Why is that? Why was that such a difficult time? And the answer is, I think, really important for retirees. And it was a bit of an aha moment for me as I looked at this data. And to get a glimpse as to what's going on, I'm going to show you another chart in William Benjamin's article. By the way, to understand this chart, you have to understand that he was a bit of a astronomy. I know nerd's probably not the right word, but he loved astronomy. So he actually picked, during this whole 26 to 76 time period, he picked 3 ugly markets, and he gave them names like the Big Bang, the Big Dipper, and the Little Dipper. Now, what's interesting, if you look at the chart, the Little Dipper is 29 to 31, and you're thinking, well, wait a minute. Shouldn't that be the Big Dipper? Or the Big Bang? Isn't that the bad time? I mean, if you look at his chart, total return, remember, he's not breaking out dividends. He's looking at total return. Total return was a negative 61% during this time. The other 2 periods, the Big Bang is what he called it, 73 to 74, and the Big Dipper, 37 to 41, they were down about half as much, or roughly. The Big Bang was down 37%. The Big Dipper was down 33%. But what he calls the Little Dipper, 29 to 31, is down 61%. How in the world is that the Little Dipper? Well, at first we may not have an answer to that, but when we go back to his chart, we know he's right. I mean, as bad as the Little Dipper was, 29 to 30, 31, people that retired then did just fine. If we define just fine as lasting 50 years, right? It was the Big Bang, the 70s, that was rough, in the late 60s. And the Big Dipper, 37 to 40 or 41, that was, again, I'm putting bad in air quotes because it still lasted a long time, but what's going on? Well, the answer is in this chart. And it's right over here, change in inflation. Remember, each year in retirement under the 4% rule, after year one, you just take 4% of your portfolio. Beginning in year 2, you adjust that by the rate of inflation. That's an important, critical item to take note of. Because when inflation runs rampant, you're increasing the amount of your withdrawals each year by a significant amount just to maintain your purchasing power, not to live a richer life, not to go on some big vacation that you couldn't have otherwise afforded. It's just to stay where you were, just the status quo. On the other hand, when inflation is more moderate, or even if we have deflation, think about a deflationary period where you might actually be able to reduce the amount you take out from one year to the next and still maintain the same purchasing power. Those 2 scenarios are worlds apart. And when you look at the Little Dipper, right, that's 29 to 31. Yes, the market was down 61%, but we were in a deflationary period. Prices decreased 15.8%. That's the difference. When you look at the Big Bang, 73 to 74, inflation is 22.1%. And I actually remember all of that. I was, how old was I? I was not even 10. And I still remember that. It was ugly. Inflation it was bad for a while. He's just showing you 73 to 74. If you're born after that and you've lived in a relatively low inflationary period, you really can't appreciate what this kind of inflation does to an economy. Now, that's not an annual. This was a change over a 2-year period. But I can remember in, I guess it's the early 80s, and I think I've mentioned this in the past, getting 16% on a 6-month CD and being scared to death to lock it into 5 years because I was afraid rates were going to go up. kind of seems silly in today's interest rate and inflationary sort of economy, market, whatever. But if you've never lived through it, it's hard to appreciate that these sorts of things can happen here in the United States. It's like, don't these only happen in, like, I don't know, Venezuela? No, they happen here too. It's just that they haven't happened in a long time. Here's the point. When you think about surviving in retirement and your portfolio, the longevity of it, having it last, it's not just about stock market returns. It's also about inflation. Inflation is huge. And as we saw in the Little Dipper, 29 to 31, you can even begin your retirement in a period where stocks just drop. I mean, they just fold like a lawn chair. But if inflation is not, double digits, runaway inflation, that's going to help a lot. It's probably going to help you get through it. Now, again, we don't know what the future is going to hold. Right now, inflation is quite modest. I mean, some are suggesting we could end up in a deflationary period. I guess we'll see. But I think it's annualized now, maybe at 1.8% or something like that. I mean, it's minuscule. And that is huge for people in retirement. Now, so what's the big takeaway? You might say, Rob, I appreciate it. Appreciate all your effort here. William Benjamin, yes, thank you. Nice charts you got on your computer screen. But how does it help me? Well, it does a couple of things. First of all, it points out that when we think about surviving in retirement, our portfolio surviving in retirement, we can't just focus on returns. We also have to factor in inflation because that's what's going to drive how much we take out of our portfolio every year, at least after year one. And it can also, at least when the inflation is low, give us some comfort that our portfolio has a much better chance of lasting. Put another way, we're much more likely to die before our portfolio runs out, which is really what we're talking about here, when you've got low inflation. The second point, the second takeaway, and this gets more specific to Josh's question, at least in part, is that Benjamin accounted for really ugly markets. His analysis was looking at actual data. Even forget inflation for a moment. These changes in the stock markets were huge. Big Bang, minus 37% over just 2 years. The Big Dipper, minus 33% over 4 years. The Little Dipper, from 29 to 31, lost 61%. And even at a 4% withdrawal rate, the portfolios did just fine, including the ones that didn't make it 50 years. They made it 35 or 40 or 45 years. I think plenty long enough for probably all retirements, but certainly the vast majority of them. And this all assumes that you continue to take that money out, that you adjust every year for inflation and take that much out. The reality is many of us are going to have at least some flexibility in how much we take out. That is to say, if the markets crash and inflation hits 15%, we're probably going to have some flexibility. We may not need to adjust our withdrawals by inflation and take out exactly that much. Maybe we can go a few years taking out 5% less. And believe it or not, and this is, I'll recommend this article to you if you're in or near retirement or if this is of interest to you. Benjamin actually discusses that very thing. The ability to take out a little less than the amount that you would take out if you simply adjusted for inflation each year can go a long way to helping a portfolio survive if we really do get into really, really ugly markets combined with high inflation. So covered in that article. I won't go into it in detail here, but worth checking out if that's something of interest to you. So the takeaway here is the 4% rule has been stress tested. By the way, it's not a guarantee, right? We know that. But when we look back at history and the numbers that Benjamin used and how he did his analysis, it went through some, certainly markets that are far uglier and economies that are far more difficult in terms of inflation than what we're now experiencing. What we'll experience tomorrow or a year from now or 10 years from now, I don't know. But at least so far, he stress tests the 4% rule with far more difficult markets and economies than what we've got at the moment. Having said that, he was looking at total return. He wasn't looking at putting money into a high yield investment where the total return, at least again, if we go back to the two investments we were looking at, just as examples, the high dividend yield and versus the the Vanguard S&P 500 index fund, where total return, at least over the last 10 years, was, I think, significantly lower for the high dividend investment than it was the S&P 500. He was assuming the market returns. He wasn't tilting it towards high dividend paying stocks. So that's an important thing to keep in mind. Now, it still raises the question that we're going to cover in the next show. Yeah, but isn't there some advantage to being able to live off dividends? If I could just live off dividends. The other question I get, by the way, related to that is, how can you get compounding if you don't get dividends and then reinvest them, right? And I kind of smile at that question because I fully understand it and appreciate it. And intuitively, the question's like, yeah, wait a minute. How can that be? You can't get compounding without, you got to reinvest the interest in a savings account, right? If you get bond interest, you have to reinvest it. Well, what if you don't get any income at all from a stock or a stock mutual fund? How does there compounding? And it's an interesting question. I always think of Warren Buffett when I get that question, because Berkshire doesn't pay a dividend. It's like, wait a minute. How did Warren Buffett get so rich if there's no compounding over there at Berkshire? And it makes you think, well, maybe there is some compounding. Maybe we've missed something. And of course, the answer is what compounds are the earnings the company makes each year, because they don't pay them out in dividends. They put them to work inside the company, and it helps them grow earnings even more, right? So yeah, you don't need dividends or interest from a company. Well, let's stick with dividends for something to compound. I mean, again, you can just look at Amazon or Google, right? They've compounded nicely and they don't pay dividends. But okay, for the next show, we're going to look at this question about dividends, and I'm going to try to show why I believe that, one, dividends don't make you richer, that they're really a lot like required minimum distributions, and as such have a lot of negatives, that generally I don't believe anyone should chase yield, that you should almost always focus on total return. And just to muddy the waters, I'm also going to talk about why I actually love the dividends that I receive, which may seem like a contradiction, but I don't think it is. Well, anyway, hope you enjoyed this show. It was a little different than others. I don't know. You may not like it. I enjoyed making this podcast, so I hope you enjoyed it. If you have any questions, I guess the best way to ask me a question is in the Facebook group. Again, doorroller.net/Facebook group. And next podcast, we'll cover the whole dividend topic thing. Until next time, remember, the best thing money can buy is financial freedom.